Hello, everyone. Welcome to today's live. My name is Lunta Di La Paulo, and I'm gonna be your host today. And we're gonna be talking exactly about seller discretionary earnings and why you should care about it as a business owner. And we're gonna be looking into some of the very much exciting items here today around what seller discretionary earnings is, how seller discretionary earnings is calculated, why it should matter to you, and especially how you can increase your seller discretionary earnings. Okay, so this live is being done in the context of our most recent offering and solution to business owners who expect or intend to exit in the next 3, 5, or even 10 years down the road. Okay, so we're gonna be covering this specific subject to help you get better and prepare your company in the event that you decide to exit from your business. Okay, so we're going to be spending about 40 minutes here today. And just for the sake of keeping time here, today is August 29th, 2024, and we're doing this live to help you get a little bit better education, better information, in order for you to continue thriving as a business owner. One thing that I'm gonna do throughout the presentation is actually sharing my screen so that we can do some basic calculations to help you understand the concept. Okay, so before we move any further, what I'm gonna do is let me actually go in here. Just give me a quick second um, to allow me to share my screen with you. Okay, so just 1 second here. Okay, give me 1 second. We are very close. We are getting very close to it. Okay. Okay. It doesn't seem like I'm getting any luck here, but okay. We are almost there. All right. So here I am. We're going to be sharing an entire screen. Perfect. Okay. So the first thing we want to start looking into is what is seller discretionary earnings. Okay. So from the expression, we can understand that we have the expression seller. Okay, let me change my pen here. I also want to change color. Okay, we have the expression seller discretionary earnings. Okay, so our basic understanding of SDE is to understand what the true profitability. Okay, what's the true profitability? What's the actual profit that somebody, what's the profitability of the company, if we exclude, right, or if we add back, give me 1 second here, add back if we add back, okay, if we add all the owner specific element. Okay, if we add back all the owner expenses, right, that they have run through the business. So when a potential business buyer approaches your company, right, they are interested to know what's the profit, that this business is actually capable of producing, right? If it wasn't being run by, a private owner who runs certain personal expenses into the business. The one way that I like to think about this is, if this company was a publicly traded company. Certainly, if you own the shares of Apple stock, the Apple Corporation, excuse me, right? You and I don't use the bank accounts of Apple to pay for our health insurance. We don't do that, right? We never do that. But for small businesses, this is very frequent, right? We pay for our own healthcare expenses. Some business owners pay for their auto, meaning their cars, right? They're paying their phone bill, internet, right? They're paying for their travels from the business, right? They're paying, let me add here, certain qualified meals, right? And many other expenses. So, as a business owner, right, as a potential buyer or as a potential seller, it's very important that this number needs to be decided or defined. What is the seller discretionary earnings, right? What is it for your business? So, let's look at an example here. Let's say a company generates revenue of $1 million, $1 million in revenue. Okay, $1 million in revenue, and they have COGS of, let's say, 200K. We're seeing a profit margin of 800, and then they have OPEX, operating expenses, of, let's say, 500,000. Our net operating income, it's gonna be 300,000. Is this the true profitability of the company? Maybe. It could be, as well as it may not necessarily be the true profitability. So let's assume that in these 500,000, okay, in these 500,000, there is 20,000 in owner's health care expenses. There is 30,000 in owner travels. There is 50,000 in other, let's say, rehab of their home, okay, giving us a total of 100,000 of expenses that are owner specific. When we add this back here, this 100,000, we get to a total of $400,000. And that's going to be our seller discretionary earnings. Okay. And this number is so important and so valuable because it helps us calculate the value of the company. Okay. So, as you probably know, many companies are sold or valued at a multiple. What happens is, if, let's say, we are looking at a company, most small businesses are sold at 2 to 5 times of their SDE, seller discretionary earnings. So let's just say a typical company will sell at 3 times multiple. Okay, let's add here plus working capital. This is plus working capital. Let's exclude this element for a moment, okay, for a second. So if I'm looking at a three times multiple, so if I multiply my 400,000 times three, I'm looking at $1.2 million potential valuation. But observe that if I was only looking at my net income that I have here above, right? If I was looking here at the net income as the figure that I'm gonna be using to appraise this company, look what happens, right? If I have 300,000 in net operating income times three, that's 900,000 valuation. Less 1.2 million, I would be short $300,000, right? So understanding and knowing the difference between your net operating income and your seller discretionary earnings can really define how much take home you get from your business, right? It's really important that you understand your seller discretionary earnings. I've seen many business owners losing value, losing money because they do not understand the concept of SDE. And sometimes the people calculating this number as well dismiss certain element, do not include certain element that should have been included, okay, into this element. But here's the other side of this calculation that we also need to understand. When we are computing our SDE, seller discretionary earnings, we also need to understand what are some of the elements that needs to be adjusted down from this metric, okay? And here's why it's important. A lot of small businesses do not pay themselves a fair market wages. They do not, right? If you are a CEO of an American company, on average, for a small business company, the figure would be between 100,000 to 200,000, okay, in wages. But many small businesses who use an S Corp strategy, especially those using an S Corp strategy, they tend to minimize, because to make the S Corp strategy to work, you need to minimize your wages so that you can take out most of your compensation as earnings, therefore avoiding the famous FICA, right? The self-employment taxes and Medicare, right? So what really happens here is in certain occasion, we actually need to adjust that number, right? If we were to run this company in in a way that reflects what the current market rates are, what would be the number we should be actually looking at? What would be the cost of certain wages we're paying ourselves as the owner, or we're paying, family members, spouse, children, or parents? Very important to consider here. Let me now open a workbook here that I'm gonna show to us that's gonna highlight some of the other elements of the seller discretionary earnings. We actually have this workbook here that we use when we are trying to compute the seller discretionary earnings for our clients. Let me make these slightly bigger. Okay. So I think we should stay at, so typically we're looking into the last 4 to 5 years. Okay. So number one item that we're looking at is the owner's wages. So let's say for our example, $1 million business in revenue, the owner pay themselves 50,000 each year. let's just keep this number flat. Okay, they pay themselves $50,000 a year the last 5 years. Okay, but the fair market rate for somebody in their position is actually 85,000. Okay, so what we need to do, right? So in our example, we would need to subtract this amount and add back what should have been there, right? To begin with, we are removing this number and including what should have been in this figure. Okay, so we're looking into payroll taxes. Let's say, for simplicity's sake, they were paying about $5,000 in payroll taxes. Okay, $5,000 in payroll taxes. Let me just select all this area and make it okay, $5,000. They paid for themselves. That seems a little bit high. Let's use $3,000, and they were paying about $5,000 in payroll taxes. Okay, and let's say they also hired their spouse and they were paying their spouse $20,000, and let's just include, the federal taxes as well there, and they were paying themselves a contribution into their 401k. Okay, around each year they contributed $4,000, and they paid for their own country club 2,500 each year. Okay, they also took vacation every year, $6,000. We're just using these numbers as an example. Okay, and they also paid some of their own household expenses, let's say around 1,500 each year. Okay, they, let's look here, meals and entertainment. Yeah, insurance is typically one of these items. They paid around 1,300 in insurance. They paid personal auto. They paid around let's just say $7,000 in auto. Family cell phone 1,500. Life insurance they paid 1,200, and they also attended conferences 1,500. And what else can we, they hired legal counsel, they paid 2,500 on average each year. So we are looking at these costs, these expenses each year, that they made. Okay, so in reality, what's actually happening here, we are looking at the seller discretionary earnings of 92,000 across the period. Okay, so let me actually remove this item here just for the sake of simplicity. And then I'm also going to remove these so that we can actually see what the SDE looks like before we start making the adjustment. So this is what the earnings actually look like to this business owner, the SDE. Okay, and we haven't added here the net operating income yet. So these are the owner specific expenses. So if we went back to our example, we know their net operating income is about 300,000 plus 107,000 that we got here. Our total is very close to 400,000, right? So again, if we're using a multiple of 3, then we're looking at a business that can be appraised at $1.2 million valuation. Okay, so this is why SDE is very important to understand. As a business owner, this is a metric that you need to know, that you need to understand, that you need to be very familiar with. because very often it's going to be one of these elements that is critical, that is key, that is taken into account, okay, when business buyers are looking to acquire your company. So now let's look into what makes this number important or less important for you as a business owner, okay? Because if you don't understand how to increase your SDE, okay, you're gonna end up, expecting to sell a company at a price that the market may not deliver to you, okay? The market may not be interested in paying such a high price if you are looking, very very recently, I was interviewing a business owner who wanted to become one of our client, and they had only $50,000 in their retirement account, and they were looking. Let me change my color here. They were looking to retire in the next 3 years. Okay, you know, you can't retire in the U.S. with $50,000 into your retirement savings. Okay, and they were looking to sell their company. Right now their business is it has consistently generated revenue close to 800,000. Okay, their profit the last 4 years has been consistently below $60,000. This is their profit. Okay, even if we are generous and say they are gonna get a 5 time multiple, that's gonna be only $3,000 that they can get at most to go fund their retirement. Okay, and what is the problem? We're not even taking into account that they live in the United States and they have to pay taxes. You have to pay federal income tax, and because you live in Illinois, you have to pay Illinois income tax as well, right? So these 200, 300K really could become close to 220K that they can have available for their retirement. So if you're a business owner who is contemplating to sell their company in the next three, let's say 5 or even 10 years, okay, this is a big dilemma because your business may not be able to actually deliver to you the financial outcomes that you aim or you seek to get, right? So that's why it's very important to consider exit planning as a solution to help you get your outcome. And this is the part that we're going to be talking about. How do you increase, okay? How do you increase your SDE? Okay, how do you do that, right? Is through exit planning. Because right now, let's just use the example of this business owner. They have a business that barely crosses 100,000 in profit. Number one, to sell it, it's gonna be tough, very tough. There's a lot of things that needs to be, you know, typically to attract very good buyers, you need to get your company to at least 500,000 in earnings, right? Your SDE needs to be at least $500,000 to attract very strong buyers who are capable to delivering to you the financial outcomes that you need. But also that really helpful to you because at $500,000, if you exit even at 4 times multiple, that puts $2 million into your pocket, right? Less taxes, maybe you'll get 1.5 to 1.6. Okay, 1.6 million. So very important to understand that, you know, when you start planning your exit, which we recommend, we always do, when you put your exit planning into motion, you actually start designing your business to deliver to you the financial or exit outcomes that you are looking for. exit outcomes that you are looking for, that you need, right? If your goal is to exit at $3 million so that you can have enough cash to support your retirement, to support your other investments or interest, then it's very important to determine whether your business can actually get you this $3 million when you exit. If your business is not at a place, let's say your business generates, $500,000 in earnings, in SDE, seller discretionary earnings, to get $3 million, you need to be able to sell at 6 times multiple. Okay. The question now is, can your business be sold at 6 times multiple? As I said earlier, right? Most businesses, most small businesses, SMEs, would sell at 2 to 5 times. Most businesses will sell around this space. Very few businesses actually get to sell at these, at 6 time multiple. Businesses that get 5 times, they are very good, very strong businesses. Okay, that have fewer problems to be solved, and the transition is gonna be smooth, and they're gonna be, great asset to generate massive returns for potential buyers. So let's say right now your business is not gonna sell at 6, maybe it could sell at 3 times. What should we do to get it at, let's say, at 5 times multiple, at least, so that you get 2.5 million? That's the job we do at exit planning, right? We start with evaluation of the company, right? We start with evaluation to see where your business is today, right? I'm gonna put it into caps. Where your business is today? What's the company's value today? How much a serious buyer would be willing to pay for your company at its current state? Okay, this is not what I often see, folks just throwing numbers out there thinking my business is worth this much or that much. This is not how it works, right? You really need to have an valuation independent valuation done, right? So that you actually know what's the value of the company today. What's the value of the company today in the eyes of a serious buyer? After that, good valuation will also show you what you need to do to increase the value. What to do to increase value. What do you need to do to increase value? Right. So that's the type of work we're doing with our clients, right? We look into at the company in an holistic manner to make sure that we are addressing every single gap so that we can maximize the value. And when the time comes for them to exit, they're gonna be at a place where they actually get three things. They can get three things, and here are the terms they want, right? When you sell a business, there are terms, and that's called deal structure. Deal structure define the terms that you get, right? Are you gonna get are you getting paid entirely, completely upfront? Are you staying around for how long? Are you financing part of the deal, the entirety of the deal, and so forth? Number two, the price, that is also largely tied up to your valuation, the perceived value of the company. Okay. And number three, the timeline. right? You can only get these three things when you manage to prepare your exit in a way that actually you get the outcomes that you want. Timeline can be something really hard to navigate, but if your business is ready for exit, even in adverse economic realities, you can still exit at somewhat favorable terms for you. But if you did not prepare your business, the odds for you of getting these three items, it's gonna be very, but very challenging for you to achieve that, to accomplish that. So I always recommend business owner to think about exit planning. It doesn't matter if they just launched their business today or they are 20 years running their company. It doesn't matter. You need to be ready. You need to, have an exit plan. If you don't, you are more likely to lose value. Okay. We know from a research from the University of Minnesota that the majority of business owners, at least in Minnesota, they're not ready to exit. They are not prepared for their business exit. Some of the most recent statistic tells us that in the US there is at least $10 trillion. Think about that. That's a huge number. That's a massive number. There is at least $10 trillion in value that will be transferred in the next 10 to 20 years from our parents' generation, from the boomers to their kids and grandkids, right? But I don't like to look into that as I have bad news for you. I don't like to look into it as a certainty. I consider this as a potential value. If we can do a good job transferring this value, if we can manage to transfer this value correctly, okay, then we can actually capture these 10 trillion or even more, okay? But the way things are right now, a lot of business owners are not ready. They're not ready. They're not prepared for their exit. Okay, it's sad to say this, but a lot of these $10 trillion could be lost because the generation of business owners aren't ready to exit. They're not preparing their companies to exit. And some of them who think my children will take over the company may not actually end up taking over the company. Okay. And that's a big problem that us as a business community need to address. And maybe the government needs to start thinking about putting in place a plan for capturing this value so that we're not going to be losing it in the next decade or so. So I'm going to pause here and stop sharing my screen. Okay. Just to give you some final words of caution and wisdom. If you are a business owner and maybe you're thinking about exiting 3, 5 years or even 10 years down the road, you really need to start preparing for your exit as soon as possible, because the sooner you begin, the more time you give yourself to actually implement, okay, your exit plan in order to get the results that you want to achieve. If you need to exit next year, then you have even less time to put in motion what needs to be put in place for you to exit. So it's going to be very important for you to make a decision, not tomorrow, not next month or next year. You need to make that decision today. You need to make that decision now around your exit. What is your exit gonna look like? What are gonna be your goal for your exit? What you looking to achieve financially with your exit, so that after you exit, you actually know what you're gonna be doing with your free time and how much money you need to continue maintaining your lifestyle since you no longer will be operating a business. Okay, so I'm gonna leave here our information. I'm gonna share my screen just one more time here so that I can leave our information here for you. And if you have, okay, it seems like my screen has frozen, not responding. So, anyways, I'm gonna pause here. I'm gonna stop. I don't see any questions, any comments. Please, if you have any questions, if you wanna reach out, in particular after the webinar, please do reach out to us. We're more than happy to support you, to help you in any ways that we can. I appreciate your time today, and I hope you find this helpful. If you haven't yet, please follow us on our social media pages, whether it's LinkedIn or Facebook or Instagram or YouTube, whatever you're following us today, subscribe. We create educational content to help business owners like you to continue getting better, because we believe when we get better results as well. So I hope this was helpful to you, and if it was helpful to you, don't hesitate to share with somebody else who could benefit from these and who didn't get the chance of attending our webinar today. Okay, so thank you for your time. God bless you, and we will talk next time.